SMF MMTs. This is a $500 call MMTs, and this is the $500 put. Now, MMTs, what you have learned, is this true or false, Rick and Ken Flagg and Will and Leo and Craig? For a lot of the new people that are here, just to mention a few names, I'll not mention all of everyone, but just what you have learned here is that when Google was putting its lows in on its daily stock chart, when Google was putting its low in at 473, which you were going to learn that when bull rallies start at bottoms, the call put in a bottom too. This is the daily stock chart right here. We put in the bottom here and the call put in the bottom. When we rallied and broke out, that call was about $25 above the market at the time, or close to about $22. The strike price, the $500 call, was $22 out of the money. Okay? When we put that bottom in and we rallied, this contract over here on the call side, MMT, was at its very finest price entry of right around $4. So a $5 entry on 10 contracts is about $5,000 here as far as your buying power goes. And that was up and out of the money. So if you had 5 contracts, it was about $2,500. My friends, 1 day, 2 day, 3 day, 4 day, 5 day, 6 day, 7 days all the way up. So that's a $45,000 move when Google finally put its first major bottom in with the broader NASDAQ rally. Bam! Big money at certain times. This one took all year for the call side to get that deflated. Why that was happening over here, MMT, is when Google made the bottom, when these contracts made the bottom, that $500 put was in the money at the time. And boy, did they make a lot of it, because you could take a look at it here. This is when we were talking about buying the put, and say you bought 5 contracts for $7. They went from $7 to this price right here of $31.75. Big move when Google was in its down trade. That $500 put, which was below the market at the time, paid a lot of money because it was out of the money down below at the 500 when Google was trading up at around 530 or 40. It broke down, and these put in a bottom, and the call put side got so inflated that when this was so deflated and this was so inflated, it was time we ring that cash register and buy this side. So you have the long-term put side, and it was time to ring the cash register and get to the bottom of it, because the equity in itself, here's the Google chart, puts it in a double daily bottom with a daily breakout. Oh my goodness, oh my goodness, oh my goodness. This is why this business is so wonderful, MMTs. Knowing what the difference is to the put to call ratio, and let us not forget that when all the indexes, we said that we're putting the bottom in, the put to call ratio on all the indexes were out of whack where bottoms get put in. And we had a super monster rally. We dropped over $23 off the high. So from that bottom, let me explain something to you, that the total movement in the equity price, and this will be applied to other ones, it was a $77.66 breakout from the breakout bottoms here. It was a $77 breakout to the top of that reversal, and out of that $77 breakout from that high, we had a 23.41 reversal in the equity itself. So that is the equity chart, $77 up and a $23 reversal right into there. And you can see the reversal on the call side. The put side is way below the market. It didn't move all that much, because you got to realize that they're going to steal more out of the $500 call, because at the time, this $500 call was $50 in the money. Whereas below the market, just the opposite of that, MMTs, and this will apply in all of your options, trading management, all of your option live videos, so you know how to use this as your reference. We hit a bottom here. The call side, the put side, which is at the time was $50 below the market. You can see here that on this particular price control down here, that we made a bottom low of $1.40. This is where the put side needed to be bought against the $500 call in the money. Because the $500 call was so inflated, and as you've learned, none of them will ever stay up here, and the public never knows when to sell them. No, what the public will do is they'll ride them potentially all the way back down here because they made their move. This is put in the bottom. Google chart puts in the top, reversal, and at the same time that Google's putting that top reversal in, this $500 put a bottom in, and the high of that $1.40, they went as high as $4.50. Okay? Because it's below, at the time, $50 below the strike price, this is where you start buying this side of the market. Public doesn't know how to do it. I'm sorry. And it was time to sell the $500 call up here because you'd already made the big move. And what happens is there's nothing but train wrecks. They're never going to stay up there. The higher that the call premium goes, that means that the stock is going to put in its highs because the stock is short term was overbought. And bam, there's your $23 reversal in the stock price over here. And the puts are right there. So we had that $23 reversal right here. That's the stock. That's the movement of the stock that moved these options. We're using the 500. We're going to do many more, but the thing of it is, it's time to, now listen, these are going to expire this coming Friday, and Google reports its earnings. To stay in this thing overnight, because there's been so much money made here, it's time to take a little bit of a, that's a $45,000 trade from that entry to selling at the high. And we always sell at the highs. Always. Because the contract almost dropped because it was deep in the money. When you're deep in the money, they take that premium out there. When you're below the strike price, they don't give you all that much to the upside yet, but they take away the call side that's deep in the money. And below the market put option, $50 below the market, is they were on sale at $1.40. There was a $3.50 move. There's a lot of room to go up here if they report a bad number. And there's a lot of room for this inflated to come all the way back down here. Bam. If they report, and it's going to be, now they're going to report earnings on the 14th of July. And these are going to expire Friday after the close. To stay in an earnings report, because Google usually makes anywhere from roughly about a $30 to a $50 move based on how they report their quarterly earnings. So you would have to have, as we already have, the $500 put at $1.50. These are free. We've already made the money here, so buying these are free. They're free. And the thing about it is, making that big move and selling into it and then buying this cheap side just for this reason. That's exactly what I said on Thursday night. Was it not, Will? Was it not, Mr. Goalie? Was it not, Mr. Flag? Yes or no?
Sir. Yes, sir.
Okay, so you all have learned it here as MMTs, Flag, that you sell there and you buy cheap over here. That was deep in the money and had to be sold, and the protection going right back to the same strike price, which was $50 below the money, had put in a low and a little bit of a pop. If Google continues to downtrend, this put will continue to go higher and this call will go lower. Now, it's also possible that Google trades sideways and or Google chart over here, they come back in at that level. We could come down and test a 50-day moving average of 520, or we could hold the support level right here, and we could tick back up into the earnings. It's going to work one way or the other. We won't know until tomorrow morning. However, we're going to do several other strike prices outside of this one. This is the Google chart. Ha, ha, ha. This is the $500 call. That was $50 in the money. This is a $500 put, which was $50 below the strike. And in the next videos that we do, this will apply to all of them. Inflated, I sell. Deflated, I buy. Trade management is what it is. Key earnings are going to move these calls and puts like you've never seen before. And I will let it be known that on this daily chart, we could run right back up. We could get support. We'll find out tomorrow morning. We could rally up into the report, which would take these put options even lower. And these put options could come back up into the inflated zone. But if we do rally up into the actual reporting session on Thursday, we're still extremely inflated. And they will not stay inflated. They must come down. They always do. They always have. They always will. MMTs, and you will rejoice in that.